All right, let's dive right into this explainer. Today, we're putting on our expert investment analyst hats to put a seriously fascinating tech company, InterDigital, through an absolute gauntlet of valuation frameworks. We're going to pull the hard data and run it through the legendary models of the investing masters to see if we can uncover its true intrinsic value.
To make that happen, we're passing this stock through 5 distinct lenses. We'll start with a quick snapshot of the company, and then move through the qualitative frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, before jumping into some strict quantitative modeling like DCF. Finally, we'll pull it all together for our final verdict.
First up, Section 1, InterDigital, a company snapshot. Let's establish exactly what we're looking at here.
So InterDigital, trading under the ticker IDCC at around $265 a share, is honestly a bit of a hidden giant. They don't actually make the phone in your pocket, but their patents are inside about 85% of them worldwide. They're a foundational wireless R&D company. Looking at their trailing metrics, they're pulling in $561 million in revenue, and they are aggressively targeting a massive $1 billion in annual recurring revenue, or ARR, by 2030. And they're doing that by expanding into 6G, consumer electronics, and AI video compression.
But here's the tricky part. You really have to weigh these massive, high-margin growth drivers against some pretty real risks. The bulls absolutely love the IoT expansion and the fact that licensing out their existing tech gives them virtually 100% gross margins. I mean, who doesn't love that? But the bears? They rightly point out the company's reliance on incredibly unpredictable courtroom battles, like their ongoing arbitration with Samsung or litigation with Lenovo and Disney, just to secure those revenues, all while the global smartphone market is kind of stagnating.
Okay, moving on to Section 2, the Warren Buffett lens. Let's see how InterDigital holds up to the Oracle of Omaha himself.
Buffett is all about a deep economic moat, right? Well, InterDigital has a massive one. They essentially tax 85% of the entire smartphone market through their patents. Their return on equity is outstanding, again, driven by those wild, near 100% gross margins on licenses. As for debt, literally a non-issue. They have a fortress of a balance sheet with a $1.2 billion cash reserve. That translates to about $15.80 in net cash per share. And if we look at owner earnings, which Buffett absolutely prizes, their free cash flow is sitting incredibly pretty at roughly $270 million over the trailing 12 months. Now, this is brilliant because it highlights a shift Buffett would totally appreciate. Historically, their earnings have been kind of lumpy, depending on the timing of massive licensing deals and past sales recognition. But management is actively converting those lumpy sales into highly predictable, recurring revenues. Pair that with an honest, shareholder-friendly management team that's already returned over $800 million to investors, and Buffett would likely see a super compelling business here. He'd probably just want a slightly better margin of safety, maybe looking to buy in closer to the $250 mark.
Next up, Section 3, the Peter Lynch lens. Let's go hunting for some growth at a reasonable price.
Lynch would probably look at InterDigital as a hybrid between a stalwart and an asset play. Why an asset play? Simply because of the sheer hidden value of that $1.2 billion cash hoard and an unbelievably deep IP portfolio that competitors literally cannot replicate. The balance sheet is exceptional. They recently reduced outstanding shares by 13%, hiked their dividend by 14%, and management is out there saying they have the capacity to double that dividend for 5 straight years. Incredible stuff. Let's put a Lynch number on it, the PEG ratio, which is price to earnings divided by the growth rate. If we assume a normalized forward PE of around 15 and factor in the 12% annualized growth rate, they need to hit that $1 billion ARR target by 2030, the PEG ratio lands near 1.25. For a cash-rich stalwart like this, Lynch would find that reasonably attractive. He'd likely rate this a solid hold, or even a buy for the patient investor.
So that begs a really fascinating question. Would the godfather of value investing, Benjamin Graham, ever touch a high-tech stock like this? Obviously, tech wasn't really his playground, but hey, math is math.
That brings us to Section 4, the Benjamin Graham lens. We are going deep, looking for that strict margin of safety.
Let's run it through his defensive investor checklist. Adequate size? Pass. At a $2.75 billion market cap, they're definitely large enough. Strong financial condition? Oh, pass with flying colors, thanks to that $1.2 billion in cash. Earning stability? Pass. They consistently generate net income. Dividend record? Pass again. Honestly, the only borderline area is having strictly moderate price-to-earnings and price-to-book ratios, simply because modern tech multiples naturally skew way higher than the industrial stocks Graham was used to. But surprisingly, IDC checks almost every single box.
But what about his intrinsic value calculation? If we apply Graham's ruthlessly strict classic formula, that's the square root of 22.5 times earnings per share times book value per share, and assume normalized tech inputs, it spits out a strict fair value around $185. Since Graham demands a massive margin of safety, he'd probably sit on the sidelines for now, waiting for a much lower entry point than today's $265.
All right, Section 5, DCF and alternative models. Let's transition away from the gurus and get into some pure, modern quantitative finance.
Building a base case discounted cash flow model requires making a few educated assumptions from our data. Step 1, we forecast free cash flows, starting from that $270 million trailing 12 months and scaling up toward management's 2030 target of $1 billion in ARR. Step 2, we calculate the terminal value using the perpetual growth method. We're assuming a conservative 2% terminal growth rate to reflect mature tech stability. Step 3, we discount those cash flows back to present value. Since the sources don't give us an exact cost of capital, we're applying a strict 9 to 10% weighted average cost of capital, or weighted average cost of cap.
When we run those specific base case assumptions, it yields a DCF fair value of approximately $345 per share. This indicates some really significant upside, suggesting the underlying cash generation of this business is way stronger than what the current $265 market price reflects.
And just look at how robust that valuation is. Even if we crank up our discount rate to a really strict 10% whack and drop the terminal growth all the way down to just 1%, the stock still models out to $285. That's still higher than its current trading price. The math here is looking very, very favorable.
Checking some alternative models just confirms this trend. The dividend discount model, or DDM, highlights extreme value when you factor in their ability to double dividends for 5 straight years while still generating excess cash to buy back shares. And if we look at a comparable PE analysis, assigning a 15 to 17 times forward multiple shows they trade at a huge discount to broader tech averages. Unsurprisingly, the Wall Street consensus price target is sitting way up there at $412.50.
Finally, Section 6, Synthesis and Final Verdict. Time to bring all these calculations together.
Here's our master matrix, and it's a super fascinating spread. Sure, a strict Benjamin Graham investor might wait for a severe market pullback to hit that $185 mark, but the quantitative DCF modeling at $345, the growth-focused Lynch lens, and the moat-focused Buffett lens all strongly point to the current $265 price being an incredibly compelling entry point, complete with a built-in margin of safety.
But hey, models don't tell the whole story, right? Context matters. The undeniable strengths here are that massive $1.2 billion cash pile, those beautiful 100% gross margins, and an IP moat protecting 85% of the entire smartphone market. The real risk? It's the business model itself. They rely heavily on aggressive litigation and arbitration with absolute titans like Apple, Samsung, and Lenovo. And that can cause severe revenue recognition delays that tend to spook impatient investors.
As LexisNexis IP impartially reports, the 5G standard essential patent space is just insanely litigious and complex right now. Courts globally are constantly stepping in to set fair, reasonable, and non-discriminatory rates. Now, InterDigital is fully armed with the verified patents and the massive cash reserves to fight and win these battles. But as an investor, you have to realize you're essentially buying into a highly aggressive legal strategy just as much as you're buying into the tech.
So, blending all our frameworks together, our final verdict at the current price is a solid buy. The sheer cash generation, the deep patent mode, and the highly favorable DCF math heavily outweigh the near-term volatility of those licensing disputes. But I'll leave you with this one thought to ponder. Is InterDigital's march to a $1 billion ARR by 2030 an inevitable reality paved by technological dominance, or will it be a grueling, litigious uphill battle every single step of the way? Thanks for geeking out over the data with me today, and as always, keep questioning the numbers.